In this presentation, we will continue with our comprehensive proprietorship problem. We're recording the adjusting entries. Remember that we are on the For more accounting information and accounting courses, visit our website at accountinginstruction.info. Adjusting entries tab here, the second tab. We recorded prepaid insurance last time, recording now supplies. So the transaction date, as all adjusted entries, will be 1/31. We're going to go through our normal thought process, just knowing that we're dealing with supplies, just knowing that it's an adjusting entry. Knowing that it is an adjusting entry means that we know that there's going to be one account on the balance sheet, or more specifically, asset or liability, that is not going to be cash, related to supplies, because we're dealing with supplies. If we know just that, we should be able to look through here and say, which one of these accounts we're going to deal with related to supplies? How about supplies? And typically, it'll be that simple when we do the adjusting entries. If it's a book problem, they'll have to tell us that we're dealing with supplies. In real life, of course, we're going to know which accounts we have to do adjusting entries for, because it's part of our system. It's part of what we set up to do. So, and we'll talk more about that. But first, we know that this account's going to be one that will be affected. Let's make that little yellow box here to indicate that will be one of them. Then there's going to be an account, we know because it's an adjusting entry, below the light blue or below equity in the income statement, either revenue or expenses related to supplies. Which one will that be? How about supplies expense? So again, pretty straightforward. We know that those are going to be the two accounts affected. They're going to say supplies in it. We're going to have to know that we're dealing with supplies. If it's a book problem, in practice, we'll know that we have to adjust for supplies each month. We know that expenses have a debit balance, because all expenses do. We know that they only go up in the debit direction, and therefore we're going to increase the expense by doing the same thing to it, another debit. So I'm going to right click and copy the supplies expense. Before we even know what we're doing, we know that that one must be the debit because it's an expense. We're going to put that up top in C8, right click and paste 1, 2, 3. Then we're going to credit the supplies account, because that's the other one that we're working with. And if we debit supplies expense, then this one must be the credit. So I'm going to right click and copy that. Put that on the bottom in C9, right click and paste 1, 2, 3. I'm going to indent that, which is probably done for you already. Go into the Home tab, Alignment, Increase, Indenting. And again, we can do all that without knowing what's going on. We just know we're dealing with supplies, and it's an adjusting entry. To get the numbers, we got to know a bit more about what's going on, and we'll discuss why we're doing what we're doing. Remember that when we think about this in terms of the adjusting entries, we're really continuing on a story that we started when we did the normal transactions. So in other words, supplies is on the books. Why is it on the books there? Well, we must have debited supplies because it's a debit, and then we credited probably cash or accounts payable. So we bought the supplies and we put it on the books as a debit to supplies rather than putting it on a debit as a supplies expense. Why? Because we hadn't yet consumed it yet, and we can't expense it until we consume it. So that's the story of how this got here. Now we're going to apparently reduce it, because we're going to be crediting supplies. And so that's going to make it go down, and we're going to record the supplies expense. Why? Because we're recording what we have consumed now. We're trying to say, okay, we told the accounting department to just put supplies on the books as an asset, and then we're going to go ahead and figure out how much has been consumed and just do that on a periodic basis. That's the system. That's what we set up to do. So now how do we do that? Well, supplies is our introduction to inventory. So if we imagine supplies stocked up a bunch of paper in the corner, now we got to figure out, well, how much of it has we consumed? And we can do that by doing a physical count, meaning at the end of the month, just like inventory, we'll go look at it and we'll count it. And we've determined that there's $5,000 worth of supplies left based on our physical count. So if there were 16,000 before that we bought minus 5,000, that means we got to bring supplies down by 11,000 to get to the physical count that we saw, 5,000. So we need to reduce this by 11,000 to bring it to our physical count. So let's do that again. In cell D8, we're going to say equals 16,000 minus 5,000. And that'll bring it, that's the 11 we got to bring it down by. And then we're going to credit the same number. So the debit and the credit will be the same. That'll be our transaction. Now there's a little caveat there. We're going to have to think a bit more about this later. You may notice that when I say we counted supplies and $5,000 worth of supplies. I kind of skipped over the fact that how do you count a dollar's worth of supplies? If I'm talking about boxes of paper, I don't know how many dollars worth of supplies necessary I have. I know how many boxes of paper there are with a physical count. And we're going to have to convert those boxes of paper to a dollar amount. If they're all the same in terms of purchase price, that's not too difficult to do. But oftentimes they'll differ in purchase price, and that's when we have to think about flow assumptions just as we would with inventory, like first in, first out, last in, first out, weighted average. We'll talk about those later, but just keep in mind that that's something we'll have to deal with typically when, say, counting supplies. We got to convert units to dollars. Okay, so then we're going to post this out, and once we do, we'll see if it does what we expect it to do. What do we expect it to do? Well, the supplies account here should go down to what the physical count is, 5,000, and we should increase the supplies expense in accordance with what was consumed during the time period, bringing down net income at the point in time it was consumed rather than when we paid for it. So here's supplies expense, and we're going to post that down here. Here's supplies expense on our trial balance. We're in column I, or we're in cell I-20, where we say equals, point to this 11,000. That's going to bring the 0 up by 11,000 to 11,000, put us out of balance by 11,000, bring net income down by 11,000. There we have it. So 11,000 out of balance, net income is going down by what we've consumed. Then we're going to go back up top and we're going to go to supplies. So in I-7, where we say equals, we're going to point to that supplies account, the 16,000 going down by 11,000 to 5,000. This is really our check figure because that should match what our physical count was. And so what happened here, of course, supplies went down, the asset went down, we have less to consume in the future, and we recorded the expense related to it, which brings net income, revenue minus expenses down. Notice the pattern here, most adjusting entries deal with expenses. Expenses only go up in the debit direction. Most adjusting entries then bring net income down. For more accounting information and accounting courses, visit our website at accountinginstruction.info.